Hi, Else here, and in this video we'll be exploring the statement of cash flows under ASPE. The statement of cash flows is the last financial statement. Although we still have the notes to the financial statements to cover, they are not a statement but an important supplement to the statements. Understanding the interconnection between the statements is critical when developing the statements. In the balance sheet video, I demonstrated the interconnection between the various statements using slides. Today, to show you a different view, I'm going to use a matrix. In the far left column, you see the statement name and the amount that is carried to another statement. If you follow the row to your right, you see which statement this amount is carried to. Let's focus on just one row as an example. Here you can see that the net income or net loss amount from the income statement is added or deducted from the opening retained earnings on the statement of retained earnings. In addition, it is used as the opening number for operating activities in the statement of cash flows under the indirect method. You can also see very quickly that the net income or net loss is never used directly in the balance sheet. By using a matrix, you can quickly see the interconnection between different financial statements. Let's go back to the full matrix and focus on the last row. It shows that the cash balance from the current assets section of the balance sheet is used as the closing cash on the statement of cash flows. If you look at the last column in the matrix, you see that the two statements which are interconnected with the statement of cash flows, the net income or net loss from the income statement, and the closing cash balance from the balance sheet. Consider using a matrix when you can, as it's a very good visual representation of the connection between the financial statements. The statement of cash flows is divided into three activities: operating, investing, and financing. Descriptions of each of these activities has already been covered in a previous video, but let's just review them quickly. Financing is activities that fund a company, either through debt or equity. Investing is activities that result from buying and selling property, plant, and equipment, intangibles, or investments. Operating is the activities that a company does every day, selling or delivering goods or services. To obtain an in-depth understanding of these activities, please see my video on business activities. The statement of cash flows can be prepared using the direct or indirect method. There is no difference between the direct and indirect method for both the investing and financing activities section of the cash flow. Under both methods, these two activities are exactly the same. That is not true, however, for operating activities. The direct method lists the inflows and outflows for each type of operating activity a company performs. Cash flow categories shown include cash collected from customers, cash paid to suppliers, and cash paid to employees, just to list a few. This method is considered more informative for stakeholders and their decision-making because it clearly shows the sources and uses of cash from operations. The indirect method focuses on the differences between net income under accrual accounting and cash from operating activities under cash accounting. It starts with net income and adjusts for non-cash items, such as adding back depreciation expense or deducting a decrease in accounts payable. The indirect method is more difficult for users to understand, but that does not stop approximately 98% of all US, European, and Canadian companies from using the indirect method to calculate cash flows from operating activities. Why? Because it is easier and less costly to prepare. Are there any benefits for stakeholders who use the statement of cash flows to assess a business? Yes. One benefit for stakeholders is that the indirect method may highlight earnings management. How? By highlighting the difference between net income and cash flows from operations. We will further explore this concept when we cover the development of cash flow statements in a later video. Considering the popularity of the indirect method for the development of the statement of cash flows, we'll be using the statement of cash flows indirect method for purposes of these videos. I will, however, also quickly show you the direct method for comparison purposes. Let's do a quick check of your understanding so far. The payment of interest on a long-term loan is considered The answer is definitely not D. All cash outflows are included on the statement of cash flows. The answer is not B. Investing activities. Debt is never part of investments. The answer is not C either. Even though debt is part of financing activities, interest paid on debt is on the income statement as an expense, and the income statement is the accrual accounting view of the operating activities. ASPE requires that it remain as part of operating activities. The answer is therefore A, an operating activity. An in-depth explanation of this will be provided in a future video. Now that we understand the activities that make up the statement of cash flows, we can look at an example. Note that the statement is so large that I've divided it into 2 slides so that you can see each activity better, but the statement is actually one statement with the 3 activities listed immediately after each other. Although I have set up the statement in columns for easy viewing, the accounts can all be listed in one column and the amounts in another. As always, the statement starts with a heading, which must include the company name, the title of the financial statement, and the period of time covered. Note, similar to the income statement and the statement of retained earnings, this statement is for a period of time, most commonly 1 year. The statement opens with the heading for operating activities and then starts with net income from the income statement. All the other amounts are reconciling items between net income from the income statement, which remember uses accrual accounting, and the cash flow from operations, which uses cash accounting. These items are known as non-cash items. This includes things such as depreciation and the change in current assets and liability accounts from the balance sheet. Again, an in-depth explanation of these adjustments will be made in a future video. For now, what's important is to simply understand the structure of the statement and why it is required under ASPE. At the bottom of this section, we see that operating activities resulted in a net cash inflow of $21,400. Investing activities are next. You'll note there's a net cash outflow of $7,500 due to the purchase of both equipment and investments. A cash outflow from investing activities is not unusual because it means that the business is investing in the future ability to generate revenue, and that's a positive thing for investors and creditors. Finally, let's look at the financing activities. Here we see that the owners of the business contributed more cash to the business and that the business paid down some of their debt. We can also see that the business paid out dividends to the owners. This ties into the $2,500 we saw in the statement of retained earnings as the dividend paid during the year. A subtotal of the financing activities is then seen. The bottom of the cash flow statement shows the net change in cash. How is this calculated? This is the summation of all 3 activities. For this cash flow, that would be the operating inflow of $21,400, investing and financing outflows of $7,500 and $1,700 respectively. This results in a change in cash during the year of $12,200, an inflow. This amount is noted on the cash flow statement. We then add this to the beginning balance of $72,300, which we obtained from the prior year's balance sheet. Remember that the closing cash from one period becomes the opening balance for the next period. Adding the change in cash to the cash from the start of the year, we get an ending cash balance of $84,500. What does this tie into from the other financial statements? This is the cash balance on the balance sheet under current assets for the current year. We can clearly see the interconnection between the balance sheet and the statement of cash flows. Let's take a quick look at the statement of cash flows again. Remember, we start with the appropriate headings and net income from the income statement. We move on to the operating activities, then the investing activities, with the financing activities listed last. The net change in cash is then added, net increase as demonstrated here, or deducted, if it is a net decrease, from the opening cash balance. This will obtain the closing cash balance, which is on the balance sheet under current assets. Now, let's quickly see the structure of the statement of cash flows when we use the direct method instead. Notice that the operating activities do not include net income or any reconciling items. Instead, the information provided focuses on where cash was received or paid. This provides better information for stakeholders to analyze and, for that reason, is preferred by ASPE, although not required. Remember that 98% of all companies use the indirect method. The investing activities and the financing activities under the direct method are exactly the same as what you saw under the indirect method. Let's check your understanding for a second. Remember to pause the video to determine your own answer before continuing. Net income is $17,100, but the cash flow from operating activities is $21,400. Why is there a difference? The answer is not E. One of the above answers is correct. The answer is not D. The question specifically says there is a difference between net income and operating activities only, so this answer does not apply. The answer is not C. The statement of cash flows, as its name implies, uses the cash basis of accounting, not the accrual basis. The answer is not A. The income statement uses the accrual basis of accounting, not the cash basis. The answer is B, because the income statement uses the accrual basis of accounting and the cash flow from operation uses the cash basis of accounting. There will always be a difference between net income and cash flow from operating activities. So what questions does the statement of cash flow answer? For investors, it helps to determine, in conjunction with the income statement, if there will be enough cash in the future to pay dividends. For lenders and other creditors, it helps determine if there is cash available to pay the debts of the company as they come due. It also helps them determine if the company will need further financing in the future. Finally, all external stakeholders will use the cash flow statement with the income statement to help predict future cash flows. We have now completed all the financial statements under ASPE, but there is an important addition to the statements which we have not covered: the notes that accompany the financial statements. And that will be the topic of our next video.